This video discusses 6 universal money rules that are often incorrect or absolutely false. Coming up next on Holy Schmidt.
Holy Schmidt!
At the Schmidt family dinner table, we often discuss the taboo subject of money. Why? Because there's so much bad information out there. I want to have the real discussion about money because without that discussion, my family members will get their information from well-intended friends or operators out there that have bad intentions. These operators use cliches and fuzzy logic. They say things like, you can't afford not to do it, etc. What we're going to discuss next are some of the universal rules that are generally not correct, or often not correct at least. Stick around to the end because number 6 is one you'll be hearing a lot if you haven't already. I don't know how it found its way into the realm of universal money rules, but it has, and it actually needs to be extinguished as quickly as possible because there's a lot of damage that can be done with rule number 6. Number 1, when you're losing money on an investment, double down. Imagine that it's early 2008 and you own 1,000 shares of General Motors. You got it from your uncle when he passed away many years ago, and you hadn't really thought much about it. It's really sitting in your brokerage account and not doing much. As time progressed that year, you noticed that things were getting a little crazy in the stock market. The words mortgage-backed securities were starting to be mentioned over and over again. You might not know what mortgage-backed securities were, but you knew that what was happening to them wasn't good. You also noticed that your GM shares had gone from $24.89 down to $17. You called your brokerage firm and talked to your broker. He said, don't worry, the whole market is down. It's not just GM. You got to ride it out. After all, in 2008, GM was celebrating its 100-year anniversary. So it was all good. You hung up the phone, went back to whatever it was you were doing, and didn't pay much more attention to the noise on television. A few months later, you noticed that GM was having funding issues. You looked up the price in the newspaper. It was $11.50. You then called your broker and told him that you were worried. Your broker said, when you're worried, that's the time to buy. You think, well, it is GM. A few weeks later, you took out a $25,000 home equity line and you bought more shares of General Motors. At that time, they were trading at $9.25 per share, so you thought, I'm going to make a killing on this stock. At the end of 2008, you found out that your GM shares were trading at $3.20. You called your stockbroker to find out if you should buy more, but at the time you called, you noticed that he and his firm, Bear Stearns, had both disappeared. You spent the next 10 years paying off that home equity loan. You're saying, yes, but Jeff, that was 14 years ago. That would never happen today. Well, then you probably don't own shares in JCPenney, Hertz, GNC, or Neiman Marcus because all of those companies went bankrupt in the last 24 months. So when someone tells you to buy low and sell high, tell them to define what low means. Universal money rule 2, always buy tax-advantaged investments. From the time we start investing, we're told to maximize our tax-advantaged investment vehicles like a 401k or an IRA. For many people, this is great advice. First, because the tax advantage is substantial, and second, without a 401k or an IRA, many people actually would not save for their future. And for clarity, there are basically 4 types of tax-advantaged investments. Tax-deferred when it goes in. This is like your 401k. When you contribute to your 401k, you contribute with pre-tax dollars, so that when you get taxed by the IRS or your state taxing authority, they tax the net amount after the contribution to your 401k. The second type of tax-advantaged vehicle is one that's tax-free when the funds come out, but you invest with after-tax dollars. This is typically a Roth IRA, and Roth IRAs have limitations, typically $6,000 if you're under 50 and $7,000 if you're 50 and older. The third type of tax-advantaged investment is one where you only pay long-term capital gains when you sell the asset. This is on an investment that you've held for over a year typically. Finally, there are investments like real estate that have special tax advantages that allow you to declare a loss but actually have positive cash flow. Those require special training and are beyond the scope of this particular discussion. But what if you're presented with a unique investment opportunity? Banks will routinely give a high yield return for the first 6 months of a deposit. There's something called a tax lien certificate, which is ultra high yielding but doesn't stay outstanding very long. And ordinary dividends are taxable at regular income tax rates. But if it's a company that pays a nice dividend and you like the company, are you going to not invest in the company simply because you have to pay tax on the dividend? The point is, all investments should be analyzed based on a holistic understanding of the opportunity. Mistake number 3 is buying an investment and not looking at it again for years. We are regularly told that when we invest, we should invest with a long-term horizon and see the investment through its up and down cycles. This is great advice because if you watch the stock market and the share price of your investment go up and down all of the time, invariably you're going to sell at the wrong time. But you can and should know what's happening with the health of your investments. Just blindly investing in a company without checking back to see how it's going is a bit like getting on an exercise program and not getting on the scale. Universal money rule number 4 is that you can't control the future. There are a few things that are certain with any investment, and the comment that you can't control the future is true-ish when it comes to your investments. You can't control what happens to an individual company that you invest in. You don't sit on the board, you're not the CEO, you don't sit in the C-suite, you don't determine the direction of the business. So from that perspective, it's absolutely true you can't control the future when it comes to a particular investment. But what you can control is the risk around owning one particular investment over owning a portfolio of investments. You do this through diversification and dollar cost averaging. Diversification means that you buy multiple companies in multiple industries. You can do this easily through a mutual fund or an index fund. Dollar cost averaging means that you buy through the cycles. Sometimes you buy high, sometimes you buy low, but at all times you continue to buy. Therefore, if a group of stocks, an index fund or a mutual fund, for example, has a bad year or two, it's an opportunity to gather more assets and offset the loss with gains in the future. Rule number 5, buying the biggest house that you can afford. When I bought my first house, the person who sold me the house said, buy the biggest house you can afford because your income will grow into it. The premise behind that is, of course, that income goes up, but also that prices go up and mortgage balances go down. Unfortunately, this is not necessarily the case anymore, particularly for someone who's approaching or in retirement. For anyone who's been watching the recent run-up in home prices, it's easy to forget that the price that you're looking at today was about the same price as it was 15 years ago. There was a dip in between. So be very careful on this one because for many, many people, the biggest house you can afford is not the right move. Whether you're in retirement or not, sometimes you just need a home for your family and you can do something else with that capital. Number 6, risk is an illusion. Risk is an illusion is quite possibly the silliest comment I've heard over the last few years, but I continue to hear it time and again, and I have comments on the channel where people say this time and again. And just for clarity, you need to know that risk is real. Otherwise, if you don't know that, you could potentially lose a lot of money. Now, why are people saying this? Well, because particularly in the last few years, they saw the stock market crash and then come skyrocketing back again. They saw house prices down and then up again. Everything seems to be moving up more or less. So when that happens, people get a false sense of security. They extrapolate that and say, if that's true with the stock market, if it's true with my house, all investments must be going up, right? When I started this video, I talked about GM. Solid company, 100 years old, member of the S&P 500 index. Yes, it had its problems, but a lot of companies did in 2008. Rock solid, at least it seemed like it was. If you had invested $10,000 in GM in 2008, you would have lost all of your money in 2009. If you had invested $10,000 in the S&P 500 index, it would be worth $50,000 today. GM was part of the S&P 500 index. So you would have lost a tiny bit of money on GM, but the other 499 companies would have helped lift the average up, despite the fact that you had a loss on one. And the biggest challenge with risk is that it doesn't have a ticker that goes by on your television screen. There isn't a price, so you can't quantify it, but you know that it's there. At least I hope you know that it's there. Even when you go to Las Vegas and you put your money on the roulette wheel on red, you know that you have a better chance of losing than winning. You don't know what percentage lower than 50-50 your odds are, but you know directionally that it's less than 50-50. Risk is not an illusion. Taking calculated risks is part of life. When you take a calculated risk, you know the risk and you know the reward. When you take a silly risk, you just think you know the reward. So I encourage you to be a risk manager in all parts of your life. If you understand risk, you'll know when it's time to move forward and when it's time to sit tight. If you like this video and you want to see more of me, please make sure you click subscribe and turn on notifications below so that you get alerted the next time I post a video. I post about twice a week. This is Jeff Schmidt. Thanks for watching.